Learn the art of investing on Moneywise.
Hello and welcome to the Moneywise Podcast. Hey, my name is Jude Fernando and I'm your host on this episode. Well, I'm sure you know it by now that through our episodes of the Moneywise Podcast, we help you take control of your finances, remind you to invest, spend smarter, and grow wealth through expert advice and suggestions, and also keep you in the know of things when it comes to your finances and investing. Now, talking about finances and investing, who better than a financial advisor to give us some expert advice, right? So on this episode, we are catching up with Rahul Jain, financial advisor, also founder of Finvisors, and Rahul currently manages portfolios and investments for clients in more than 175 cities across 26 countries. Rahul, welcome to the Moneywise Podcast. Good to have you here. How are you doing?
Thanks a lot, Jude. Thanks for the lovely introduction. I'm doing good. How are you? And hi to the audience as well.
Doing good. Thanks a lot. Thank you for making some time to be part of this episode. Why don't we start with getting to know a little more about how did you get into being a financial advisor? What sparked your interest in becoming a financial advisor, Rahul?
So after my MBA, I was working with a large private sector bank. I was in Mumbai. I did a lot of work on, managing investments for clients, managing savings, FD, deposits, etc. for a large set, more than 500 branches. For a couple of years, I was with a consulting firm. I helped set up banks, entities, etc. And then due to some family emergencies, I shifted back to my hometown in Udaipur. Now, while returning back, honestly, this was not in the plans. But looking at the people, they had a lot of money, but they did not know where to invest. And there was a lot of financial mis-selling happening across, RMs and people. So what I did was I thought, let me get into this. This is something that has been my area of expertise, something that I worked on throughout my career. And that is how it all started. And luckily, it went off well. So today I'm managing clients across countries, across geographies, across continents. To say the least, I'm managing clients across 5 continents today, and it's just been 6 years. So I'm happy that I'm able to help people achieve what they were earlier not able to achieve, they were not aware of. So happy to impart financial knowledge, literacy, and also, this is something that I felt is very necessary in every household.
Oh, yes, very true. Rahul, while financial literacy, helps investors make more informed and educated decisions about their investments, tell us how significant is investor behavior when it comes to achieving financial success?
So honestly speaking, Jude, behavior is often as important as market performance in determining your long-term success or your goals, right? It is very important to have emotional control and discipline while you start your investing journey. The critical aspects here are a lot of people try to time the market. That is something that nobody has ever been able to do. You might be able to do it once or twice, but not always. For me, being disciplined and adhering to your targets and goals and adhering to your risk appetite is very important. Whenever the market goes up, you will see every person, even a guy who has the risk appetite of a FD, trying to get into small caps. This happened recently. So this is something that I feel is very important. You should know what your risk appetite is, what your goals are. And your behavior will always determine your long-term success. If you try and time the market, that you will exit when the market is high and enter when the market is low, you will not be able to do it always.
Right. All right. You said behavior will determine your long-term success, right? During which there are chances of, say, falling prey to biases or even investors making mistakes. So what are some of them? I mean, some common mistakes that investors make due to emotional or irrational decisions?
Some of the most common mistakes that people make are, first, when the market falls, they start selling in panic. Now, one of the biggest investors across the globe, he says that be greedy when others are fearful and be fearful when others are greedy. Now, quoting that person, I would say this is something that people don't adhere to. They would want, when the market is high, people want the market to fall so that they can invest more. But when it starts falling, people run away from the market. Markets are bad. We want to exit. Let's not increase our losses. That is one. Second is, chasing trends or quick profits without any strategy. So I get a lot of calls from people saying that we want quick money. You tell us something which is for 3 months, 6 months, 1 year. We don't want to do a 5-year investing. Now that is the difference between an investor and a trader. So when you want to invest with a long-term horizon and be very clear on what you want to get. And the most important mistake that people make is being overconfident during bull markets. Now what that does is it might give you short-term returns, but as we saw in the last 1 month, the market fell by over 10%. Now, this is something that impacted a lot of investors who just entered the market only after seeing 1.5 years of bull run. Now, their risk appetite was that of a FD guy, very 60, 70-year-old people calling up and saying that we want to invest in small caps because they have done really well. So chasing or tracking only the historical returns will not always generate profits for you. And that is a mistake that a lot of investors make.
Oh, okay. That's something to keep in mind when it comes to tracking historical returns. Now, having shared this with us, any real life examples that you could share with us? Real life examples where investors' behavior led to a significant financial loss or gain?
Yeah, sure. I will share one for the gain and one for the loss.
All right.
One significant loss that a person made, it was more of an opportunity loss for that person. In 2020, when the markets fell down, from 42,000, they started falling down. Now that investor was willing to invest everything. They had a big chunk. They were willing to invest everything at say 37,000. But they invested 25%. When the market fell further, when it say from 42,000, the Sensex came down to 37, then 34. At 34, that person was like, let me wait for 30,000 and then I'll enter. The markets fell down to 30,000, then the target was 25,000. It came down to 26 or 25,900. Then that person's entering target was 20,000. That I'll only enter when it hits 20,000. Now, unfortunately for that person, the market recovered and from 26,000, it went to 39,000 within a span of say 6 months. Now, the same person now had a statement that market has already run up by 50% from its bottom. So I'll wait for it to correct and then enter again. And now that person has never been able to enter. Market have become 3x from those levels. Today it's more than 78,000. Now that person has had a significant loss. Had he entered or even done a SIP or a disciplined approach of investing, he would have made good money. That is an example of a person who lost a significant chunk. The second one is, of course, when the markets were lower, and there were investors who were seeing returns of minus 40%. They had entered in 2019. But being long-term investors and having understood that you should enter when the markets are lower, they kept putting in money when the markets were lower. They had their SIPs running and they kept putting in lump sums, and that actually helped. Today they are seeing returns in excess of, I don't want to quote a number, it's multi-fold returns for them in like last 5 years.
Oh, that's nice. So emotional control and discipline are very critical. So what are some of the habits that one should follow, like key habits or behaviors that lead to long-term wealth creation, Rahul?
So one of the most important things is being patient. Okay. You can't expect returns to show up in a day. Like as we say, Rome was not built in a day. So you can't expect anybody to see a multi-bagger return within a month or 2 months. There can be exceptional scenarios. So one thing is being patient. At the same time, you have to continuously invest, right? If you have money, you can't try and time the market. You should invest consistently. At the same time, every year or every 6 months, you should also do a regular portfolio review to understand, how expensive are the valuations of different categories. Today, some sector might be overvalued, some sector might be undervalued. So you need to rebalance your portfolio. Or say initially when you started, your target was to put 50% into large caps, 25% into mid caps, and say 25% into small caps. After a year of a bull run of mid and small caps, your exposure changed. So you have to rebalance your portfolio to ensure you don't take a hit. The next important thing is diversification. So you need to optimally diversify your portfolio across asset classes, across funds, across different. So, there are different asset classes. You will have equities, you will have fixed income, you will have, commodities like gold and silver, you will have real estate. So you can't stick to any one, right? You will have cycles for each of the asset classes. So you have to optimally diversify. And then the most important of all these things is after doing all these, you have to stick to your financial plan. So you have to create a plan or have a goal in mind, invest according to that. You might need to add more when the market is down. You might have an option of doing certain profit booking and then reinvesting when the market is lower, when your goal is reached. So that is important. One most important thing that I like to add here is that you can't be all into equities if you don't have emergency funds. A lot of people make this mistake that they don't have emergency funds. They don't have coverage, insurance coverage. And when such a situation arises, they have to liquidate all their investments. And you are pushed back by 5 to 10 years because you did not have a cover. So another important thing is don't make this mistake. Have sufficient coverage for yourself and your family, and then create a proper financial plan and goal and invest according to it.
Thank you for that piece of advice. And Rahul, I believe you've made it like a mission to impart financial knowledge to individuals, right? So I wanted to ask you, what role does a financial advisor like you play in managing investors' emotions and behavior?
What is very important, as we discussed throughout the podcast, is your psychological behavior or your emotions should not overcome your financial decisions. Now what happens is a financial advisor or a distributor, right, they will act as a buffer between your emotions and decisions. They will not let them overpower you. When the market is falling, a person might have a psyche to exit the market, but a financial advisor will tell him that this is not the right time to exit. This is rather a time to put in more. If you want some money, if you want to exit, and if the goal is still 6 months or 1 year away, you might as well wait like maybe 2-3 months before your goal and exit, and vice versa as well. In a peak market, if a client is planning to put in a big chunk of lump sum because of FOMO, fear of missing out. So if they are thinking this is a market and I'll miss out if I don't put in a lump sum, the financial advisor will tell them this is not the right time to enter with a lump sum. You might as well enter through an STP or SIP. So offering rational advice during market highs and lows is a very critical part of a financial advisor's job. Again, a financial advisor will also help his or her clients, to stay focused on long-term strategies. A lot of people, they want to invest in equities for 6 months or 1 year, especially on the mutual fund side. Now, this is something where a financial advisor will come and tell him that this is a very risky call. It might go haywire if you have a goal coming down, say after a year. For example, your daughter's education or your son's higher education, which is something that you can't push further. You should not enter equities. It should be more of a fixed income approach, where you should not take risks on such an, you should not listen to your other so-called on the road tea time conversation people. Don't listen to them just for the sake of investing. You should take a calculated approach, and you should stay invested for long term. For short term also, you should have an optimal plan without taking undue risks, because that is something that you cannot afford.
Okay. So while it's best to get expert advice, and you also said calculated approach, right?
Yes.
So what, according to you, is like the best way for new investors to build healthy financial habits?
The most critical piece is start early, even with the smallest of amounts. Whatever you can do, start early. The day you get a job or the day you start earning money, a lot of people start earning money in the college itself. Start investing. I get a lot of clients who come to me at the age of 45, 50 saying that we've never invested and this is the mistake we made now. The problem is time does not wait for anybody, and time is the biggest beneficiary for young people. If you start at 20, even with the smallest amount, just to give you a perspective, a number, somebody doing 500 rupees a month is negligible, 6,000 rupees a year. But if he stays invested for say 50 years, that becomes approximately 1.82 crores at a return of 12%. That's a significant chunk. So if you start early, that would be really useful. The second important thing is, at an early age, you should start educating yourself. Understand the basics of investing. Understand the power of compounding. That will actually help you understand and invest. If you have a clear mindset on why you want to invest, where you want to invest, right? At that time, it will be really useful for you to compound and build your wealth. This educating part can happen anytime during your life, and it's an ever growing process. This learning never ends. So you should keep learning. Lastly, you should stay patient and avoid trying to time the market. If you stay invested in the market, you give the market time, right? So as the statement comes, right, you should not time the market. Timing is not important. Time in the market is more important these days. So the more you stay invested, the better your compounding will be. Just to give you a small example, if you look at the calculation of somebody who wanting to invest, say, 10,000 rupees a month for 20 years, if they invest for the first 10 years and then do not invest for the next 10 years, versus another guy who starts after 10 years and invests 15,000 rupees a month. Even in this case, the guy, even at 12% compounding, the guy who started investing early, even though he invested less money, would have a significantly higher chunk at the end of 20 years. So that is the power of compounding. So to all our listeners and viewers, I would like to say that, manage your behavior. Don't mix your emotions with your financial decisions, and never try to time the market. Be patient and you will make money. Just ensure you are investing in the right asset classes and you are regularly monitoring your portfolio.
All right. So never try to time the market. Ensure to invest in the right asset classes, monitor your portfolio, and be patient. And also do not mix your emotions with your financial decisions. Well, I think some key takeaways for us today through this podcast, Rahul. Well, that was Rahul Jain, financial advisor and also the founder of Finvisors, who currently manages portfolios and investments for clients in more than 175 cities across 26 countries. Rahul, thank you for giving us some insights and giving us some learning. Thank you for joining us on this episode of the Moneywise Podcast.
Thanks a lot, Jude. Thanks a lot to all the patient listeners for listening to me so very carefully. And thanks, Jude, for having me here. Thank you.
You're listening to Moneywise, brought to you by Bandhan Mutual Fund. Check out the rest of our series for more insights on investment and personal finance. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.